And so where we go from here critically depends on a number of key factors. You know, I want to be clear about something. Our base case scenario is still that we will get to recovery, but we've attached what we like to call a non-zero probability to a double dip. Non-zero maybe is a little too conservative. I'd say the probability of a double dip is probably about as high as it can be without it becoming our base case scenario. We've rerun the exercise just last week. It's about 40%. 40% probability of a double dip. The key to determining where we go is how the issues I've highlighted here play out. Now I understand that there are more issues we can talk about, but these are just sort of the main buckets of risk that we're looking at. And keep in mind that the outcome of each one of these critically impacts the next. And so what I'd like to do for you today is to outline these key drivers of our forecast in a way that hopefully helps you with your planning, in a way that highlights maybe what we're keeping an eye on, what you should be keeping an eye on over the next year or two. First question is around the global consumer. And let me be clear. When I say the global consumer, I mean the US consumer. Now don't get me wrong, there are a lot of really interesting issues with other consumers around the world, the emerging market consumer, the Chinese consumer, but for now, it's still about the US consumers. Because when an economist looks at a makeup of an economy, we typically say the makeup of an economy, there are four forces that drive an economy, four components of GDP. Consumer spending, business spending, government spending, and overseas demand. That's it. And in the US, the consumer accounts for 70% of that. 70%. There's not a country on this planet that relies on one component for 70% of GDP. And if the US accounts for 20% of the global economy, that puts the US consumer directly responsible for 14 cents of every dollar in the global economy. So it's why I don't buy the notion of decoupling that we talked about earlier this morning, and I'd be happy to talk more about it in the Q&A, but 14 cents every dollar in the global economy directly to the US consumer. So if this global economy is going to recover the way some say it's doing, I need that guy to start spending, right? So what's happening with the US consumer? Well, there's always been one set of indicators that has sort of acted as a forward-looking measure of where the consumer is headed, one guide to where the consumer is going. It's been nearly a perfect predictor. What is it, right? The housing market. Housing market speaks both to the availability of credit and to consumer confidence. And we just finished saying that it could be another year, maybe even 2 years, before we see balance restored in the US housing market. I mean, look, maybe I'm just looking at things too simplistically, and so my challenge to you is tell me what I'm missing. But when I look at the consumer, when I look at how a consumer can spend money, I see that there are four ways a consumer can spend money. He can spend what he makes in the form of wages. He can spend what he has in the form of savings. He can take equity out of his home, and he can borrow. That's it. And if I were just to break it down, most consumers don't have enough money in the bank. They're in debt up to their eyeballs, and they've already taken the equity out of their home. Almost $2 trillion worth. The consumer added more debt to his portfolio in the last 7 years than he did in the previous 40 years combined. 40 years. I mean, you talk about digging a hole deep. That's going to take a long time to climb out. It's going to be hard to borrow money when debt to disposable income in the United States is at 119%. Now, sure, it's down from peak. I heard Helmut mention this morning that it's down from its peak. Sure, it's down from peak. It's still well over the average of the last 30 years, which is 90%. Debt to disposable income at 119%. So we expect the consumer over the next little while to focus his efforts on rebuilding his savings. And this is not something that turns in a quarter or two. And when I say that, I think about the fact that household net worth, between 2007 and 2009, household net worth declined by 27%. It was down by $17.5 trillion. In 2001, we had recession, the tech wreck, September 11th, a wave of corporate accounting scandals. Household net worth declined by 10%. It was down by just over $4 trillion in more than 2 years. We're talking about close to $18 trillion of wealth destruction in less than 2 years. So for me, what's happened here is a behavior-changing event. It will change behaviors forever. Or at least for 5 years, whichever comes first. But it'll change the way people view their spending habits. It'll change the way people view their spending habits. So what's left in terms of how a consumer can spend money? We talked about savings, we talked about home equity. Wages, right? Simple. Okay, so let's take a look. There's 3 ways that employers can increase their employees' wages. They can pay them more money, they can work them longer hours, or they can hire more workers. So let's have a look. Are we hiring more workers in the US? Unemployment close to 10%? I don't think we're doing that, not right away. And that's just the official unemployment. What about all those folks that left the workforce, that gave up looking for jobs, the discouraged workers, the hidden unemployed? When you add them to the mix, unemployment is 11.6%. And even that underestimates the extent of the overcapacity because it doesn't take into account all those folks that are working part-time that need to be working full-time. So that's going to affect consumers' ability to spend. How about total compensation? Rising or falling? Well, with more than 6 unemployed Americans for every job opening, competition for jobs is pretty fierce in the US. I say wages don't have much room to climb in the next little while. In fact, I read recently that call centers in the United States are now starting to rival call centers in India in terms of cost. Imagine that. We've lived through offshoring. We could see reshoring. How about the work week? Well, the work week is a function of inventories, and that tends to fluctuate through a recession. So that's been boosted here and there, but it's still well below that stable level that it was at prior to August 2008. So given where savings and income is at, the consumer is at risk going forward. And this is the case in the US, it's the case in Europe, and it's the case in Japan. Right there, I've just named almost half the global economy. The next risk that could topple us over, you guessed it, the banks. Extraordinary measures have helped, or did help this sector avert total, complete annihilation and collapse. And in some cases, actually, we're seeing in earnings reports this week, return the sector to profitability in some cases. But now those measures are being unwound. And a look at past financial crises tells us that defaults in the financial sector tend to lag the economic cycle. That is, you have less demand for goods and services, you have less need for people who produce those goods and services. Now, that happens with a bit of a lag. Eventually you get hit on employment, but that happens with a bit of a lag because companies are reluctant to fire and rehire. There's a cost associated with that. But eventually we expect to see a hit on employment, and we're seeing that now. Weak employment, poor consumption, declining production, all make it more difficult for the consumer and for the businesses, for the companies, to service their debt. Now, borrowers will hold on as long as they can, but eventually, we expect to see what economists call second-round effects through the financial sector. Can't pay their debts. And we're seeing that now, right? Delinquency notices are on the rise, except this time the banks are already on their knees from what had happened previously. To make matters worse, banks' exposure to the sovereigns and companies of countries like Greece, Spain, and Portugal. Foreign bank exposure to those 3 countries, $2.5 trillion. And it's not even the US banks that I'm worried about. It's the European banks. But they've stress tested their banks, right? That's what we're told. They've stress tested their banks. It's all right. What can we make of a stress test that didn't reveal a single Spanish bank and only 1 Greek bank? So I happen to believe that the euphoria in Europe these days, the Europhoria, is grossly misplaced. So it goes without saying that as the loans that the banks were previously counting on to be the good loans start to turn bad, that could potentially be disruptive for the world economy's growth path. And if banks lose, say, another $1 trillion, what does that do to lending? Well, if banks lose $1 trillion, it reduces lending by $8 trillion based on the old capital adequacy rules. It's likely to be more under Basel III. We're already seeing European banks tighten their lending standards again. And that's not good for anyone, because a lower level of credit can't support the same level of economic activity. And it's why you see markets take such a huge hit every time new developments come out with respect to the banking sector, with respect to